Lucid just posted one of its strongest revenue growth quarters ever, but the stock is still struggling. Lucid's third quarter 2025 earnings showed clear operational progress, but also highlighted why investors remain cautious. Revenue surged approximately 68% year-over-year, reaching roughly $336 million, a major jump compared to prior years. Vehicle deliveries climbed nearly 47% year-over-year, with Lucid delivering over 4,000 vehicles, showing continued progress in scaling production. Despite rising revenue, profitability remains a challenge. Adjusted EBITDA stayed negative, reflecting ongoing heavy investment in manufacturing, technology, and expansion. Lucid also reported a net loss exceeding $1 billion for the quarter, underscoring just how expensive scaling an EV business can be. Following earnings, Lucid stock initially rose on the revenue beat, but broader market sentiment quickly turned cautious. Shares have been trading near multi-year lows, pressured by weak margins, capital concerns, and broader EV sector volatility. Several analysts lowered price targets, citing Lucid's ongoing funding needs and long path to profitability. Lucid is clearly growing, but growth without profits increases risk. This is common for EV startups, yet investors must decide how much patience they're willing to have. Lucid has strengthened liquidity through credit facilities and convertible note offerings totaling nearly $1 billion. This supports operations, but it may also lead to shareholder dilution. Lucid trimmed its 2025 production guidance to around 18,000 vehicles, signaling execution or supply chain challenges. This adjustment can impact investor confidence. Some analysts see long-term upside if Lucid executes well. Others remain cautious, pointing to extended timelines and continued capital needs. Lucid is also facing industry-wide pressures: fluctuating EV demand, rising competition, and changing government incentives. Lucid's revenue growth and delivery gains show real progress, but profitability remains distant, and stock volatility is likely to continue. For long-term investors, success may depend on execution, cost control, and disciplined capital management. If you're buying real estate the way everyone else is, you're already losing. This one mistake is costing real estate investors six figures. Nobody tells first-time investors this until it's too late. The market just shifted, and most investors haven't noticed. What worked in real estate last year could destroy your returns this year. Smart investors are doing the opposite of the crowd right now. Here's why buying more properties could actually make you poorer. This strategy looks risky, but it's how wealthy investors scale fast. I wouldn't buy another property until I understood this. Here's what the data actually shows. Let me break this down simply. This changes everything for investors. Pay close attention to this next part. Most real estate investors are wrong about this. Here's why. And here's what actually works. Should you really buy property right now? Most people don't understand this risk. Here's the smarter move. Everyone says real estate is passive income. That's only true if you do this.
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.